Welcome to Talk Tickers. So Ouster just dropped a record quarter with absolutely fantastic growth. So why on earth did the stock immediately get hammered by Wall Street? We're going to break down their Q3 earnings and really try to understand this huge disconnect between the company's actual performance and the market's reaction.
On the surface, this was a classic beat and miss quarter. You know the type. Ouster absolutely crushed it on revenue expectations, pulling in record sales. But when investors looked a little further down the income statement, they did not like what they saw on the bottom line. The company missed its profitability targets.
And the market's verdict? It was swift and it was unforgiving. The stock got punished immediately in after-hours trading, which sent a really clear signal. Impressive growth, all by itself, was just not going to cut it this quarter. So let's dig into the numbers and see why. Okay, to really understand that sharp, negative reaction, we have to peel back the layers of the financials. You know, the income statement, the balance sheet. And we're going to start with those headline numbers.
All right, here's the raw data. You can see revenue came in at a strong $39.5 million. That comfortably beat Wall Street's expectation of around $37 million. But that GAAP EPS, the earnings per share of negative 37 cents, that was a big miss. Analysts were really hoping for a loss closer to 28 cents.
And you know, that revenue beat isn't just a one-off thing. This actually marks Ouster's 11th straight quarter of revenue growth. I mean, that's nearly 3 years of consistent expansion. It just proves there is a powerful, growing demand for their lidar sensors.
And they are very well capitalized to fund all this continued growth. Ouster ended the quarter with an incredibly strong balance sheet. They're holding $247 million in cash and equivalents, and this is really important, they're carrying zero debt.
So you've got strong growth and a fortress balance sheet. What's the story management is telling investors? Well, it's all about playing the long game, and it really centers on this concept they've started calling physical AI.
The CEO, Angus Pacala, is trying to frame Ouster as something more than just a company that sells sensors. He wants you to see them as a provider of physical AI. The big idea here is to combine their advanced lidar hardware with intelligent software, creating a system that doesn't just see the world, but actually understands it. It lets machines make smarter decisions on their own.
And that whole physical AI vision, it's being deployed right now across a really diverse set of industries. This growth isn't just some bet on passenger cars way down the road. It's being led by immediate, real-world applications in things like smart infrastructure. Think managing traffic at intersections, and in industrial automation, like equipping all those warehouse robots.
Management really hammered this point home with a baseball metaphor. And the message is pretty clear. The current revenue, yeah, it's growing fast, but it is just a tiny fraction of the massive market opportunity they see ahead. This is their justification for the heavy investment spending we're seeing. But that compelling long-term vision, it seems to have fallen on deaf ears. On earnings night, the market was not interested in the dugout story. It was focused squarely on the immediate negatives. And this slide right here, this just brilliantly illustrates the fundamental disconnect. On one hand, you have management selling this multi-year vision, but the market, on the other hand, is focused on right now. The profitability miss, the rate the company is burning through its cash, and the way it's issuing new stock to fund operations, which, you know, can dilute the value for existing shareholders. Because while revenue is climbing, and that's great, the company is burning a significant amount of cash to get that growth. I mean, a net loss of over $21 million this quarter, combined with raising nearly $94 million by issuing new stock this year, those are tough numbers for short-term focused investors to swallow. And you can see the direct impact of those concerns right here on the chart. The stock just faced intense selling pressure for 3 straight sessions right after the earnings call. It wiped out recent gains before it finally started to find a floor.
Okay, so you weigh that strong operational story against the market's very real profitability concerns. Where does that leave us? Here's our call on what to expect from Ouster heading into the next quarter.
First, we fully expect Ouster to continue its strong commercial execution. We think they'll meet or maybe even beat the high end of their own Q4 revenue guidance. The growth engine is still firing on all cylinders, no doubt about it.
However, the stock price is likely going to stay stuck in this range, bouncing around for a while. Until the market sees a clear, believable path to sustainable profitability, and we're talking specifically about a positive adjusted EBITDA, which is a key measure of cash flow, it's just hard to see a catalyst for a major move higher. So this whole analysis leads us to a market perform rating. The company's solid execution and its growth are probably already priced into the stock at these levels. But that lack of near-term profitability is going to act as a ceiling, really capping the potential upside for now.
Ultimately, this leaves every investor with a really critical question to think about before the next earnings report. Are you investing for the dugout, for the long game, or are you investing for the game being played right now? Your answer to that is really going to determine how you view this stock.
And as always, please remember to do your own research. This is not financial advice.